Hi, everyone. Blair Tushaus here, partner and advisor here at Tushaus Wealth Management. I'm here to give a current economic and market overview. There's been a lot going on, so I just want to dive into some of the things that are going on that have been occurring in the past couple of weeks, things to be concerned about, things to be thankful for. But overall, what can we do with this information and how we can move forward and bring out some opportunities? So, first of all, the economy overview. The economy has remained just resilient, and that's despite where interest rates are. The 10-year Treasury went up to over 4.6%. That is extremely high for what we've seen in this past several months. It is slowly, steadily increasing. It has since gone back down, but the market is reacting as if the rates are going down, and the market's really just ignoring that. So, bond market and stock market are kind of saying two different stories. So, who should we believe? But regardless, when rates go up, everyone thinks, my mortgage, or if I get a mortgage, it sounds bad, but there's still opportunities when rates go higher. For those with annuities out there, I always say when rates go down, we should be looking at refinancing debt or mortgages. But when rates go higher, we should be looking at our annuities or our fixed income, anything that credits us, because we should be refinancing higher. So those with annuities out there, regardless of any type of annuities, those are the times to be reviewing your annuities and saying, hey, how can I improve this in some way, shape, or form to get better growth? Some people get annuities and they don't do anything with them. There's still things that can be done. So just moving forward, consumer spending is still overall healthy. People are becoming more selective of certain things, valuing certain things. Just talked to a buddy of mine who is in luxury landscape design. So I think the consumer is still spending, but maybe choosing moving away from luxury or items that maybe they don't need to spend on after that conversation with that friend. Those kind of maybe not needed things, but want things are kind of going down, but the things that are still needed are still being spent on. So, anyways, inflation has cooled, but we're still seeing, we're as the Feds call it sticky inflation. It's not as high as it once was, back in 22, 23, but it's still sticky. It's still not to the federal target, which was down to 2%, which if you think about it in comparison, all the way back to the 80s, 2% is very aggressive. I would love for it to be there because I would like to refinance my mortgage, but at the same time, while rates where they're at, let's take advantage of those opportunities. So, the question is, how do these economic conditions affect maybe the overall market? Today, as I am speaking, which is Friday, May 22nd, we have just sworn in the new Fed chair, Kevin Warsh. I think I said his name correctly. And he was nominated and selected by President Donald J. Trump, who, regardless of political views, is probably going to select somebody who is pro rate cuts. So that, just knowing what we know, how does that affect, the markets? The market's going to maybe start pricing in cuts sooner. Uh, Currently they're not because the 10 year is rising. But if we do see those rate cuts in the future, the market's probably going to like that unless we see inflation come back. Then we're in a bad spot, right? So there's consequences to every decision. So overall, sticky inflation. How's the Fed going to balance that versus the pressure of cutting rates? So the stock market. So we talked about the economy. How does the stock market get affected? Well, we saw one of the greatest rebounds from a casual 9 to 10% drop from market high to low. We saw one of the biggest rebounds as far as not just percentage, but how fast it happened. And you have to ask yourself, how healthy is that to see a market rebound that fast? Well, the saying goes, the market climbs a wall of worry. And, we can worry about this all we want and kind of dread the consequences. But, you know, time has shown that the market has these pullbacks, but it just climbs and climbs and climbs. Should we expect or anticipate 10, 20, and 30+% drops along the way? Of course, but what does it always do 10 out of 10 times? It recovers and moves forward. Now, the timing of that may change. The durations and percentages will all change. Nobody has that crystal ball to know when those things will occur, but when they do, it's important, it's critical, especially pre-retirees and retirees, to have investments that are principal protected, that can participate in the upside. I've had lengthy videos about the defined outcome or buffer ETFs that we personally use for the people we service. Um, I talked about one of my go-to buffers the last time I got on here. This time, there's several buffers out there that I'm really, really engaged into. There's one that has a 10% downside protection over a given 12-month period, annual period, and I get 80% of whatever the market does. So 10% buffer, meaning if the market goes down 10, I'm down 0. If it goes down 15, I'm only down 5. And on the upside, if the market goes up 10, I'm up 8. If it goes up 20, I'm up 16. That's the kind of risk reward I'm trying to seek in this kind of volatile environment. Remember, midterm election years are very volatile. Um, in fact, this has kind of been a somewhat tame midterm election year. The last midterm election year was 2022. We saw peak to trough was in that 20% dip. I think it was 22% regards to the S&P 500 index. So we saw in that 22%, it wasn't just a straight drop. It was up, down, up, down, up, down. Granted, we were dealing with different inflationary, headaches at that time. We have different headaches today, the Iran war, the sticky inflation. So we should expect volatility. We should not shy away from the market. We should have some level of protection. At the same time, we should achieve as much upside as we can without being fully exposed to the market. So, what is doing well in the market? Well, what are the two letters that everyone's talking about? AI, artificial intelligence. Oh man, if your company is not talked about AI in some way, shape, or form, it's it's kind of the leaders of the market. I just read the stat this morning. Anywhere from, depending on the given moment, 36 to 40% um, of the index of the market is the top 10 stocks, and those top 10 stocks are heavily associated to AI or semiconductors, or those sectors that are really pushing forward. There's a lot of companies that are trying to incorporate AI into their business models, and trying to provide value within, or depending on their business model. So we're seeing AI companies just drive forward as they do, and other companies lag. We see that, like I said, 38, 40% of those top 10 stocks take up a bigger percentage of the overall index. And so what we pose to people is, how healthy is that for generally speaking, the market? It's not, when we see the top 10 out of 500 compose 40% of an index, that's generally not healthy. It's kind of signs of a inflated market, a bubble, something that eventually will come back down to reality. So don't shy away from growth, but at the same time, we can't ignore just some of these simple stats of that almost ring kind of reminder of the dot-com bubble, internet, and it just kind of balloon. The internet, the dot-com bubble could have blown up in '98, but it grew and it grew. So my point is that, the market, even though it says it should come back, doesn't mean it's going to come back on your timing. It could still go up, year after year. When it finally does come back down to reality, if we had a crystal ball, it'd make our jobs a little easier. So we're talking now about the market and investor sentiment. There's kind of bull perspectives, meaning people who think the market will go up, and bearish uh, people who think this is just crazy times. And I can understand both sides of the story. At the end of the day, we go back to the people we service are going to have that initial planning work done, and they're going to have a game plan where it's exact amount of risk taken according to their planning work. So it shouldn't be like, I like this. I like this company or that company, or we should do this. No, it all derives back to that planning process, getting something implemented to where we know exactly how much risk we should take, and then getting as much upside for that amount of risk. So some planning considerations that we're having discussions in our client meetings: the higher interest rate opportunity, reviewing annuities, making sure that having that discussion about, okay, if we have a high yield or a yield producing investment, that being in a trust or taxable account, that's 1099 income. How could we avoid that, but take advantage of that high interest rate environment? Every day I talk to somebody who has, I have 100,000 in my Chase savings and it's getting me 0.01%. I struggle with this because the banks are taking advantage of that. They're loaning that out to Mr. and Mrs. Smith, to their mortgage. The mortgage rate's 7%, and the bank is totally taking advantage of the money you're just placing there. There are other opportunities besides your savings account. So please, if that's something of concern, reach out to us. Be happy to give you some better ideas out there. And some other things, planning consideration wise, a lot of variables are going to come in effect here. Income needs, tax efficiency, risk tolerance. Those are some of the things that, if you haven't reviewed yet, you need to sit down with somebody, a fiduciary, tax planners like ourselves, who can review all those things and understand exactly, on an annual basis, your planning work. Because what is implemented this year could be different than the next year based on different income that you may expect. So overall, we're in exciting times. It is a unique economy, no matter what side of the aisle on, no matter if you're a bear or a bull, no matter if you're about to retire or somebody younger who has their next 30 years to invest. It's very interesting times. If you do have any questions about the planning work, about some of the economic or market or the buffer ETFs that we use, or you want to have your annuity reviewed for those kind of interest rate increasing your rates, things like that, please reach out to us. I'll provide my information below and we can have a conversation moving forward. So I hope everyone has a great Memorial Day weekend, and we will talk soon. Take care.